You can follow patterns throughout history. No doubt they repeat themselves. Some are more exaggerated than others. Some seem to occur out of nowhere, but it always seems so obvious when you look back in the pages of history and seems impossible to recognize when you're right in the middle of it. So where are we now? You came here for the truth, so let me unveil that for you. Today we're going to look at several charts. Let's begin. Consumer confidence versus the savings rate percentage. And you will note that there are chasms that form throughout history and lead us to where we are today. You can see what has happened currently during the financial crisis and during the dot-com boom and bust. Every single time we encounter this ratio between the two, a crash follows. Does that guarantee that we are about to hit a crash point right now? Is this the tipping point? Is this the breaking point? The linchpin, has it been pulled? Well, this is just one indicator. If you've been on this channel for a while, you know that I have covered literally hundreds and hundreds of different indicators over these years. And I've shown you ones that have been positive, other ones that have been negative, ones that have grown, ones that have shrank, and I've shown you this all over the world. But right now, we are seeing so many indicators showing the true weakness of the economy. Not the stock market. I realize that. The stock market is up, you don't have to tell me. I'm talking about the real economy, the real indicators showing you the weakness. Now, the further along we go in all this fraud, the worse the inevitable crash becomes. That's the problem. Look, if you're making your way in the stock market and everything's rising, and then eventually it hits a point, and then everything starts to tumble down. Well, are you going to sell right here at this point? Or maybe here? Or maybe you'll recognize that that was the top and you're going to sell here? Well, the optimum way would be to sell on the way up positions, and you would be able to recognize that top. You'd be sold off as it was falling down. But most people, they don't do that. They're not sophisticated. They're investing with a financial advisor. And that's where a lot of the money goes. It goes through all these different financial establishments. Somebody else is managing the money. So what do? Well, they hold on for dear life. But they're holding on through these crashes that oftentimes in history take years and years and years to recover from. But the most people say, look, I'm in this for the long haul. I don't need to worry about the quote-unquote short-term gains. But a lot of times, in fact, if you look at the stock markets here, 10 years to get back to the levels previously reached. 10 years, that's a long time. That's a long time. That could mean a big difference for a lot of people, particularly those who are at that point where they need their money, they're ready to retire, and their pension funds, there's a shortfall. There's a little piece of news that comes out and shows how they're unfunded and we have big problems. Maybe they're going to be cut back. Maybe they're going to be reformed. Nobody thinks about that. They just look at the Apple stock, the Amazon stock, and they think, I'm good. It's not the way it works. You need to understand the ripple effect. You need to understand how one stock affects another, how one sector affects another, how one company can affect another, and you need to really look at it for what it is. This is just one indicator. There are literally thousands and thousands and thousands of indicators. I've covered so many here on this channel. Just wanted to note the fact that, look, yes, that's one indicator, but it doesn't tell the whole story. I get that. The Fed funds rate. We saw previously, if we study this and we can sort of make a judgment based on how they're going to do it next time around, you can see what they have done. Looking at this through the 2000s, they're doing the same sort of business, these small steps upward, always too slow. And it wasn't long before they had to start dropping them again. And of course, they don't react ever quick enough. They don't react strong enough. The financial conditions, okay? looking at this here, what happens? Oh, everything is just fine up until the moment where it's not. That's usually the way it is. It happens in a flash. Most people are not ready for it. So could we expect the same thing in this case? I believe we can. It's, of course, when nobody's expecting it. Consumer credit outstanding. This is directly from the Federal Reserve's website. And you'll see that total revolving credit, whether we're looking at as a total percentage change, let's say, for example. I mean, as it goes on in general, you can see that this has been increasing. Doesn't matter how you want to look at it in the revolving credit, for example. That's credit card debt, basically. Looking at total flow, these are up significantly. All I wanted to note was the fact that, in general, credit card debt is expanding rapidly. I've also noted the fact that we can see these payday advance or cash money type businesses are really expanding. Consumer loans down 7.7 billion year over year, and credit card is up 1.7 billion and 1.3 billion year over year. Okay. Now, this chart here doesn't tell you the whole picture, but basically we're looking at well over $1 trillion worth of credit card debt. Now, this credit card debt, a lot of people, a good percentage of people, it's not people that they're taking on the credit card debt and they pay it off before the end of the month. It doesn't work like that. They take it on and they pay the minimum. So we are talking about massive amounts of interest that people are paying. Then you look at, like I said, with all these cash money, cash advance, all this stuff, they are paying extremely high rates on these different types of businesses. And most people, they cannot afford that. There is no question. They basically take out a $100 loan when you know you're desperate, when you have to take out a $100 loan. And they end up paying back $200, even $300 a lot of times from the statistics that I've read. So people are really heavily indebted right now at this time, and it's simply getting worse. The average consumer, I'm not talking about what the stock market is doing. I'm talking about the average person, a lot of people, a big chunk of people. Think about all those people, and I'll try to do a video about it, but that without the government safety nets in place, we have people living in dire straits. And that is a fact. There's no other way to put that. They're literally living because of the government handouts. And they expect it too. And, you know, it's been there for a long time, so I understand why they expect it. But unfortunately, they continuously have been warning, we're going to cut back, we're going to have to reforming entitlements. They use all these different terms. They're going to impose more taxes. They're going to, either way, you're left with less at the end of the day. A lot of people aren't prepared for that. And then you look at the S&P 500 price to sales ratio, completely blown by what happened during the financial crisis. But we are now at the level, yet again, of the dot-com boom and bust. I've noticed this to be very consistent, actually. A lot of the statistics we've gone way past this time around, comparing to the financial crisis. And we are now in the tech boom and bust era. And there was a lot of euphoria. You saw that. I mean, interest rates were dropping significantly. The stock market was moving up. Housing was moving up. Everything was in a boom cycle and business was good. Okay, so we had relatively stable times, we could say, and things were booming. And then you had the tech boom. Everything was just, money was just being thrown into it. It doesn't even matter. What is it? I don't care. Here's some money. And that's the way things were. It was completely exaggerated. In fact, I was just remembering today a time around that era, actually after the tech boom and bust. I wasn't too aware of exactly how significant it was at the time, but I walked into a business that they had a whole bunch of, it was basically a small trader floor, and there was one guy. This one guy was the only person left in that company, at least at that particular location. The entire rest of the business was gone. And that's the way it was. He probably was ready to go after I left anyway. But that's the type of euphoria that is experienced. We are seeing that coming up today in different technicals that we see. Whether it will end here, I don't know. I think ultimately it depends on when the Federal Reserve and the other central banks are ready to crash the market. They make that decision. Think about it. Stocks start crashing tomorrow, right? The Federal Reserve will just print up $2 quadrillion. Here you go. There you go. Push the stocks up. Buy all the shares. Why not? Well, they could have done so in 2008. They could have done so in 2000. They could have done it so many times before, but they didn't. Why? Because they want a crash. They have been manipulating the system since its creation of 1913. Why wouldn't they do it in these particular points? Oh, is it political? Are there reasons for it? They couldn't manage it. They couldn't get the approval. No, it doesn't work like that. And you know it doesn't. We know that this is all because of a consolidation of power and control. And each time around that there is a crash, they use that crisis as an opportunity. Thank you for your quote, Rahm Emanuel. If you found this video informative, please give me a thumbs up. Don't forget to hit that subscribe button. We are now at 80,000 subscribers here on this channel. I want to say hello to each and every one of you out there. Thank you all for those who support me through Patreon, through the cryptocurrency donations, through PayPal donations. Thank you to all of you very much. If you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. There are links in the description below. Take care.